Okay, good afternoon, everyone, to our afternoon session. It's 1400 Ukrainian time. I'm today's session, for this session, the session chair. My name is Jan-Hendrik Meyer, and I would like to invite all participants to write their questions about to the presenters into the chat or raise their hands in the aftermath of the presentations. I already see on my screen our first presenter. It is Andriy Bielinski, and the topic of his talk is correlational and non-extensive nature of carbon dioxide pricing market. Andrei, are you ready to present?
Yes, do you hear me?
Yes, wonderful.
Okay, so do you see my screen?
Yes, but it's not yet in presenter mode. Yet now it is.
Okay.
Then the stage is yours.
Okay, thanks a lot. So, good afternoon, dear listeners. My name is Andriy Bielinski. I'm a student of Kryvyi Rih State Pedagogical University from Computer Science and Applied Mathematics Department. First of all, I would like to thank the organizers of the conference for such wonderful organization of the conference, a high quality review, and such attention to the quality of the published papers. We've been presenting our papers for 4 years in a row, and we really like this conference. And the number of citations and readers and participants indicates that you are on the right track. So today I would like to present you our study, which is titled as Correlational and Non-Extensive Nature of Carbon Dioxide Pricing Market. Before I will start, I would like to present you a plan of my presentation. First of all, I would like to give an object and topic of our research. Then I want to present the concept of statistical entropy of Boltzmann and Gibbs, and following from it, a non-extensive statistics and its instrument, which is known as Thales triplet. After it, I would like to present you the random matrix theory, which will give us necessary indicators estimated over multiple carbon time series. Each of our approaches will be followed by corresponding empirical results. Then I would like to give some conclusions from all of these approaches. So, achieving sustainable development is arguably the most pressing issue of our time. One of the main reasons is the simple fact that we have no other viable choice. Today, hundreds of indicators and indices of sustainable development have been developed and used at the global, national, and local scales. And each policymaker should have knowledge about the current state of energy and sustainability in their country and other countries in order to help alleviate the problems and develop the country. They must also have a conscious and balanced choice in terms of sustainability indicators so that they can provide development and operation conditions for their country. Thus, indicators that are based on complex systems theory can be used as a strong tool in the hands of policymakers to assess the level of sustainability of different areas and energy sectors and activities. So again, the object of our research is carbon dioxide and stock markets. The instruments which we are using is the non-extensive statistics and random matrix theory. And the relevance is identification of crisis states and search for new approaches for modeling critical events. Further, the daily prices of carbon regarding carbon emissions futures time series for the period from 4th July 2008 to 10 May 2021 are analyzed. Moreover, the dynamics of emissions is dependent on the economical situation of a specific country and the whole world. In order to present a more comprehensive technical analysis of the certain drops in the carbon emissions market, for comparison, the Dow Jones Industrial Average Index is selected because it's considered the most quoted and the most reliable financial barometer in the whole world. The Dow Jones data were obtained for the same period. And for the study of correlational processes in the carbon dioxide emission markets, we used the daily data of the power sector from the US Carbon Monitor for the period from 1st January 2019 to 10 May 2021. It contains other most active emitters of carbon dioxide, including individual countries such as USA, Germany, China, India, United Kingdom, etc., and global emissions across the world. Here we calculate our indicators for standardized returns and its modulus. So the non-extensive statistics that will be presented later were preceded by classical Boltzmann entropy, which was later modified by Gibbs. And Boltzmann-Gibbs statistical entropy and related classical statistical mechanics are extremely useful tools in the study of a wide range of simple systems. And these physical systems, for which, of course, it's advisable to use classical statistics and the theory developed on its basis, can be conditionally characterized by an additivity of noise, the presence of intense chaos, Euclidean geometry of the phase space, and short memory or local interactions between the elements of the system. And actually, also its dynamics is very similar to normal Gaussian. And such systems really well described by the additive Boltzmann-Gibbs entropy and classical statistics. But there is, however, a whole range of natural, artificial, and social systems in which, in contrast to those mentioned above, there are systems that are characterized by a long range of spatial-temporal correlations, multiplicativity of noise, hierarchy, or usually multifractality of the geometry of phase space, and non-Gaussian dynamics. Therefore, later, the Brazilian physicist Constantino Salles derived non-additive entropy and the corresponding function of the Q logarithm and Q exponents. And Salles found that complex non-extensive systems that have inherent correlations can be described by the Q triplet, namely by Q sense, which identify chaos in the system or sensitivity to initial conditions, and Q exponential divergence of nearby trajectories. Also, Salles identified Q relaxation, which describes the relaxation of correlated values, and Q stationary, Q start, which determines how much the probability distribution deviates from the normal, or in other words, how heavy the tails of this distribution appears to be. We can see that for the system close to the normal distribution, all three parameters must be approximate or equal to 1. But if the system appears to be non-extensive, then the presented relation must be executed. So in the works of various authors, systems of different nature were studied, such as stock indexes, different biological systems, seismic systems, and space systems. And it was actually determined that almost all of them can be presented and can be well described by non-extensive statistics. Before I will present empirical results, I would like to shortly describe algorithms for computing corresponding parameters. First of all, here we have Q-stationary calculation algorithm that determines the length of the tails of a probability distribution. So for each calculation, firstly, we need to find the difference between the current and previous values of the signal. Then we calculate the histogram for them and normalize it. And after the values of the histogram are substituted to the Q logarithm, we try to find such value of Q that the values presented on this graph are linearized as possible, or in other words, we try to find the coefficient of determination of the calculated linear regression to be as close as possible to 1. And in the future, the selected value of Q will act as Q start, which we substitute for the Q Gaussian. So from this slide, we can see empirical distribution of CO2 time series. We can see Q Gaussian, and we can see a standard Gaussian distribution applied to our data. And as you can see, our power law or Q Gaussian distribution in this case is much more suitable for such signals comparing to usual Gaussian distribution. And actually the same we can see for our Dow Jones index. So here we can see Q relaxation, which for most real systems determines the Q exponential rate of correlation decline. And it can be determined using autocorrelation function. Also, we try to use mutual information instead of autocorrelation function, but for our task, there wasn't so much difference between autocorrelation and mutual information. So we stopped on autocorrelation function. And the procedure for calculating it is similar to QSTART, except that we substitute the value of the autocorrelation function for the Q logarithm. And the presented slide shows autocorrelation plot for standardized returns and volatility, or module of standardized returns. And volatility in our case follows power law. So as it was proposed by different studies, we should compute Q relaxation for exactly volatility, or modules of standardized returns. So the presented slide shows a formula for calculating Q sensitivity, or Q-sense, which determines how chaotic the system we are studying appears. And Tsalis found that the alpha mean and alpha max values, which define the ends of the multifractality or singularity spectrum, can be used to identify chaos in the system. Actually, multifractality is the characteristic of the system to have the spectrum of different fractal dimensions. And the corresponding alpha mean and alpha max values from multifractality spectrum, they were obtained using multifractal determinant fluctuation analysis. So in this slide, we can see a table with the characteristic exponents for the whole time series of CO2 and Dow Jones index. And as we can see, for the whole time series, actually our relation doesn't fit. So here we can see that we should have Q relaxation bigger than Q start, but we have here the opposite. So actually for CO2, non-extensive statistics may be not very suitable when calculating it for the whole time series. But as we can see for Dow Jones index, we have such relation. So definitely Q relaxation is much bigger than Q start, and Q start bigger than Q sense. So for Dow Jones index, this relation confirms. But in for our task, we use sliding window approach to consider non-extensivity not for the whole time series, but across the time. So we calculate all procedures for different subsets of our time series to track how non-extensivity actually changes across different times. And here we can see corresponding empirical results of Q start for CO2, for Dow Jones. Here we can see Q relaxation for CO2 and for Dow Jones also. And here we can see Q sensitivity for CO2 and here for Dow Jones. So the next is random matrix theory. And random matrix theory, with this we can define how differ our signal from completely random, or how correlated are the energy markets and how collective their behavior. In our case, first of all, we construct correlation matrices of initial databases that is presented here, and for the shuffled or random matrices. And in this slide, we can see how some of the countries and the energy markets are correlated. And then we can apply sliding window procedure, find averaged correlation coefficient, and study the dynamics of energy market across the world. Also, we can look at the distribution of the pairwise correlation coefficients, and we see that the most of its parts differ from those for random matrix. So we can conclude that CO2 emissions of different countries are presented to be significantly correlated. And using such tool as RMT, we're mostly interested in the statistical properties of eigenvalues and eigenvectors. And from it, we know that the probability distribution of the eigenvalues for random matrix is presented by the following equation. So in further, we will compare the probability distribution of eigenvalues of initial databases and of the random. So in this slide is presented the distribution of the initial databases comparing to the distribution of eigenvalues of the random matrix. And we see that eigenvalues of initial carbon market is far away from the random. Also, we are interested in such measures as inverse participation ratio and absorption ratio. And these measures can help us to define how many components participate in each eigenvector. Low inverse participation ratio will indicate that all assets move in a similar fashion, responding to the overall trend of the market. In contrast, a large inverse participation ratio would imply that the factor is driven by the dynamics of a small number of assets. And AR is a cumulative risk measure which measures the fraction of the overall variance in returns explained by a subset of RMT. And we can see the evolution of each eigenvalue across time and rolling window dynamics of inverse participation ratio. For our task, we will use the largest eigenvalue as it gives us much more information comparing to others. And for the last slide, we can see that the dynamics of participation ratio, lambda max, and absorption ratio, and the dynamics of the water emissions. And empirical results present that in time of COVID, 3 indicators were increasing, which indicated about more collective response before the pandemic. So thus, it can be determined that the nature of carbon dioxide pricing market and its crisis states appears to be actually non-extensive in some way. And definitely CO2 and Dow Jones are characterized by long memory or long spatial temporal correlations also they're characterized by long tails or heavy tails in their distribution. And definitely there are plenty of research which we need to do. But the most prominent is that we need to define actually another parameters that can be included to this triplet, because definitely systems are not also characterized by multifractal characteristic or by correlations or by heavy tails, but also by different other parameters. So also in our further research, we are going to combine our methods that we use here and such methods from machine learning, deep learning, or maybe even quantum mechanics, quantum informatics. So thank you for your attention. Would be glad to answer your questions. Thank you for your attention.
Thank you very much, Andre. Are there any questions from the auditory, from the participants? So maybe you take a little time. Nevertheless, Vitaly and me had the same idea. I would like to know, are you really interested in CO2 emissions, carbon dioxide emissions, or are you interested in the math of your methods that you use? Because you have to decide if you really want to come to a publishable result. You need to decide whether you follow this path or this path. That's extremely different, you know. If you want to write a methodological paper, you don't need necessarily any data for that. But if you want to research CO2 emissions, probably you should more focus on the research of your research question. So what determines the price of CO2 and lesser the math.
Mm-hmm.
Nevertheless, what Vitaly and me wanted to know, there are a lot of standard models that are used in today's econometrics to do the research of time series, just like you did. Vitaly mentioned ARIMA and moving average stationary and non-stationary time series. I mentioned some vector autoregression and Granger causality test. And they are applied millions of times in the literature. And you do something completely different. So what is the advantage of your methodology towards or in comparison to those standard models?
Thank you for your question. Well, as I mentioned, different studies were applied to different systems and especially to financial systems. But I think the main part of these indicators, the advantage, is that they were applied to different systems, not only financial, but for natural, for physical systems. And they presented themselves as very prominent and very reliable. And people using such approach could characterize how presented to be the system, and they could identify different critical events, especially in seismic, where we have such shakes in Earth. And definitely we shouldn't forget about standard econometrical approaches, and we shouldn't forget about standard indicators that are presented on different exchanges. In my opinion, we should combine them, and these approaches, their applicability to different systems, their universality, that's the advantage. And in my opinion, the combination of these indicators and already approved and used every day, I think that they can give the most fruitful results in further. Definitely, here we should think about also, I think, some trading strategies that are relied on these indicators, because there are a lot of work to do, actually. And as I said, except just only those indicators, we should apply methods from machine learning and deep learning to make forecasts, to know at which time we should expect crisis, because we know that our system is presented to be more heavily tailed, or presented to be more correlated, and we know that we should expect crisis, but when we should expect it, at which point of time. And that's why we should use another approaches to confirm and to make our forecasts more reliable in further. So this indicators is much more like additional feature to our trading, to our decision making.
Okay, Vitaly, did I fully reflect your question? Okay. I wrote another question into the chat. The emission futures that you use, are those futures on the European emissions or futures on what emissions?
So yeah, as I said, we use a database from US Carbon Monitor, and there are emissions from different sectors, from United States, Germany, India, from different countries, almost 20 or 40 countries, as I remember, approximately 40 countries. And except it, there are also such as global indicator of world emissions, so combined emissions from different countries. So except individual countries, we use indicators that combine emissions from the main countries, the most developed.
Okay, but I can see their carbon emissions future in your footnote there. So futures are derivatives on special financial instruments.
Actually, sorry, I actually don't remember, and I think if to look in investing.com lately, we present a database in we presented link in our paper, so if people are really interested, they can look at this link and look from to which country it's related.
Okay. Are there further questions? I see that it is not, seemingly it is not the case. I don't see any raised hands. Then thank you very much, Andre.
Thank you very much.
And then we come to our next presenter, that is Tatiana, with designing an algorithm for capturing price volatility factors at the stock market.
Good afternoon, everybody. I hope you can see my screen.
Yes, it's perfect.
Is it moving?
Yes, it is.
Okay, great. Okay, first of all, thank you very much for the opportunity to be here and to present my research. Not only my research, actually, if you see from the first slide, it's teamwork, and I'm happy to be a presenter of the results of this teamwork. Actually, 2 years ago, again at the same workshop, I presented the initial research, which was started from developing the algorithm for share prices forecasting. Again, it was done by the same team. But today, it's a complementary results which we which are needed to improve our first research and actually make the forecasting algorithm more precise. Also, well, first of all, the structure of my presentation is on the screen. I will say some words about motivation. So why do we care about earnings season and why it's important? And then I briefly explain hypothesis, literature review. Also, I explain sample design and methodology and interim results. What is interesting, that sample design is also part of our interim results because it's part of the algorithm to determine factors for share prices forecasting, and conclusions, limitations, and further discussions. So why do we care about earnings season? Well, first of all, quarterly reports are often used as an indicator of the company's development trends and predicting performance indicators. It's part of our nature. We always look back to understand, trying to understand what happened in the future. Also, for investors and active traders, it's the most important time for trading because volatility creates a lot of opportunities to get more money on speculations. And also, price movements during earnings season can determine price trends for the future, I mean, not long term, but for the next, at least for the next quarter. Well, this is why the aim of the paper is to design an algorithm to be used to identify factors influencing price dynamics of shares at the time of publication of quarterly reports. Our hypothesis, it is assumed that price volatility during quarter reporting periods can be influenced by such factors as capitalization of companies, number of short positions, change in value of companies during the year, forecasted earnings, forecasted turnover, difference between forecasted and actual earnings, etc. Of course, we can't include all possible factors, and the decision about these factors was made based on literature, not only on literature review, but also based on request from the stock market traders, because actually they are main users of our algorithm. Regarding literature review, sometimes when I do research, I'm very happy if I see a lot of papers, especially new papers. It's kind of, it makes my work easier. But actually, when we start working on these papers, and I was responsible for literature review, and at the beginning, I was so happy to see how many possible papers can be included in the literature review. But actually, it's not very easy because the papers, they all are different, and it's like you can't really find a similar pattern. Going like deep into the literature review, I understood why, because the factors for different markets, the factors for different requests, they are different, and this is why. Actually, we determined five main groups of research related to our work. The first one, it's a study about reaction of share prices to the news at the beginning of earnings season, or semi-called timing effect. The second group of research, it's about tone in the quarterly reports, and the third and fourth, they kind of contradictory, because the one group of the researchers, they actually prove that a reporting frequency reduces asymmetry of information. And from the other side, there is a different type of research which proved that mandatory reports actually increase information asymmetry because they motivate managers to manipulate by figures in financial reports, which also influence share prices. Well, it's kind of interesting because both type of research, they're they're from the same period of time, but from different markets, which is also should be considered for the future research. And the fifth group of papers, it's how developed and developing markets react on different quarterly reports, because actually in different markets it's can be quite opposite, because different patterns from traders, different trends for different companies, and all these factors actually determine share prices trends for different markets. And how our research is different? Well, first of all, we consider the difference between type of disclosure, because in our sample we didn't include annual disclosure of information, only quarter or semi-quarter and semi-annual. This is why the title is about earnings season. And also we developed a 5-stage algorithm to determine price factors in the current season, to predict share prices for the next season. And about sample design and methodology. Actually, I remember that during the reviewing process, we received some interesting comments from different reviewers. And one of the comments was about our sample, because we filtered it a couple times and reduced it to certain number of companies. But actually, it's not a methodological error. It's actually part of the algorithm, because this algorithm is used cyclically for different period of time, and the forecast process must be adjusted according to change after each earnings season. This is why each earnings season, basically, we have a new updated group of companies for calculations. So talking about choosing companies, we covered the period, earnings season period before COVID-19 crisis. So just to avoid questions about how COVID influenced our sample, it didn't. Actually, the influence should be considered in the next stage. This is why, again, it's important to filter companies for each earnings season, because capitalization changes and also the activity of companies changes. Actually, the first stage of the audit is to design the sample, and at the first stage, we chose companies which perform interim disclosure of information, and then we use two filters to clear the data. The first one is market capitalization, and the second one is average volume of traded shares per day. So we try to keep in our sample only active companies, which allows us to reduce the size of error. And at the first stage, the sample consists of 791 companies, and they represent 8 different industries, and they cover almost 85% of US stock market. The second filter is it's about the second stage. It's a next filter stage. So we use this filter we call at price volatility, and actually we looked at prices for opening and closing the trading session, and also maximum and minimum price for a day. And if a company performs significant price changes, as the difference between prices during 3 survey days, and the price was twice bigger than the average price, it company is included in the sample. And after this stage, we had a sample from 200 companies. So basically, we went from 791 to 200 companies. And these companies are those who were the most active during the earnings season. And these companies, they cover 70% of US market. And here at this slide, you see the main the number of companies in different industries, and the black bar shows the number of active companies in the same industry. And after the end of the filtering, the sample of companies consists of which consists of 200 companies, which represent different industries. But the major companies, they are from technology industry, from financial sector, and also from services. The other representatives from basic materials, consumer goods, healthcare, industrials, they have almost equal shares, but again, even though that they have a smaller share in the general example, in the all example, it doesn't mean that they are less active, which I'll explain later during the presentation. So then the third stage of the development. At the third stage, we found out that the most active companies were those which value was volatile during the last year, and also those companies which have many open positions in the total numbers of shares available for trading, and also less capitalized companies. Even those that we have a minimum requirement for capitalization, but it's still like some companies, they are more capitalized, some companies less capitalized. So basically, this information is important for traders because understanding of behavior patterns of these companies helps to develop trade strategies for the next period. The next stage of the algorithm actually is the correlation analysis between different factors. And I didn't put everything on slide because actually we have very big tables, and you can see more in our paper. But I just want to point out, I just want to focus your attention on the most important results. The greatest influence on price movements during the period of quarterly reports is the indicator of short position of shares, and it's here on this part of the screen. It's 0.68, and this can be explained by the fact that shares are long-term value driver, which is mostly used by investors for long-term strategies. And short positions in equities are mainly used by speculators in companies that run into problems, thus increasing the risk and volatility of these equities. Accordingly, at the time of the report, the management of the company may present a report of strong performance or say that one is expected, which may be a significant motive for exit from the short position. Also, short squeeze often arise when there are many bear stocks in open position, which on the average were selling a low price, and on good news, some start to buy, others cover short position also buy. This is a situation when almost nobody sells, or there is a liquidity deficit and share prices rises sharply, forcing other market players, even those convincing on the lack of the company's future, to exit the company as the balance runs out of cash. That is why if in companies with many short positions, share prices can be very volatile at the time of the report. And also another non-financial indicator influencing price movement during the 3 days after the reporting period, it is capitalization. And so it's here. And here everything is more predictable in that the larger company is less volatile in its price movement. This is explained by the fact that such companies have a high float and there's a constant liquidity, and by the fact that it's very important to go beyond forecast at the time of the report. So the next slide, it's here. So the next slide, it's about financial factors, and actually it's more about changing in prices. And the most interesting result that when we did analysis, we found out that during first 2 days, usual prices fell, and on the third day they rise, but it's not at this. The increase in prices, it's not in the same speed. But when we did correlation analysis, we actually found almost no correlation. Well, you see the zeros or very low correlation because the prices went in the opposite directions. This is why even from this stage of analysis, we see where we can, how we can adjust our algorithm, how we can improve our algorithm. Talking about next stages and development of the research and practical implications, actually, we found out that the highest price dynamics were observed during the quarter reporting period, and it's due to different reasons. Sometimes it's manipulation with figures, sometimes it's problems with liquidity. The largest impact on price movements during the period was seen by number of open short positions and capitalization of companies, which I already explained. Among financial indicators, the strong influence on the price movement at pre-market and post-market gap has a forecast for the next quarter earnings per share and revenue forecast. And the company's results were also affected by a lower impact on price movements during the quarterly period. Regarding the limitations and what are we going to do the next, because as I told you, it's an initial stage of this part of our research about factors determinations. And yes, we tried it in practice, it works, but there is still some room for improvement. Well, first of all, as I mentioned, it's about price movements in different directions, which cause negative correlation in our calculations. We're thinking about dividing all companies in a sample by 2 groups, depending on the stage of development. Such selection can be made based on the coefficient of book value of the company to market value of the company, as well as on the dynamics on revenue growth and P/E ratio. That will allow the impact of factors for each group to be identified as it appeared in the research process, that they can be different for these groups. Also, according to our research, one of the most important indicators that influence the share price performance is the number of short positions. And it is possible to deepen the research by in-depth study of the capital structure in terms of share volumes, how many shares belongs to insiders and pension and hedge funds, how many shares are owned by individuals. Then it is possible to assess the impact of certain groups of shareholders on stock exchange prices. In particular, insiders can be the first to know accurate information, or they can spread provocative information. Individuals are the most responsive to the reports, and hedge funds and pension funds have large portfolios of shares and look forward to the earnings season to close their position on the back of high liquidity during this period, significantly increasing the volatility prices. I was trying to be short and keep the timing and leave some room for questions. This is information about our team. Our slides are published, and if you want to ask more questions, even after the presentation, you can send us those questions. Thank you very much, and and I'm looking for your questions. Looking forward to hearing your questions.
Thank you very much, Tatiana. And Marina raised her hand. Marina.
Yeah, thank you. As I understand it, first of all, thank you very much for the presentation. As I understand it, you're planning to continue this research. So my question is, are you going to include in the algorithm a variable which captures the tone of the report disclosure?
Thank you very much, Marina, for the question. Actually, it's not very easy to answer. Actually, the tone is very important. Is very important factor, but we didn't find the possibility to combine this financial factors and tone factors, because the tone itself, it's a very complicated algorithm to implement, to inbuilt in the forecasting algorithm. So it's like it's already complicated, but including tone, it just makes it's more complicated. We don't want to say that tone doesn't influence at all. It is it has a great influence, especially and in imperfect markets, it has significant impact, but it must be just a separate. So to my mind, at this stage of our work, it just can be a separate algorithm. Didn't find the possibility to combine them.
Thank you.
I also see a question in the chat, which was written by Vitaly. Did you calculate determination coefficient for price multiple regression with all factors? If yes, what results did you receive? Yes, we did calculate, and the results, part of the results I showed at the screen, and part of the results are in our paper. And actually, talking about coefficients of part of the results were expected, but part of the results were not expected. For example, we didn't expect that price volatility will show like low correlation. It just, but well, I guess we found out why it happened. It's just because of a very short period of study, and the prices moved into different directions. And basically, they just neutralized. Positive effect was neutralized by negative effect.
Thank you for your answer. Thank you.
Are there further questions? I don't see further hands risen, and I don't see further questions in the chat. Tanya, thank you very much for your wonderful presentation. And then we go over to the next presenter. That is Sergey, with development of robo-advisor system for personalized investment and insurance portfolio generation. Where's my presenter?
Yeah, hello.
There he is. Wonderful.
Yeah, can you see my screen?
Yes, perfect.
Yeah, okay. So let me introduce our research development of robo-advisor system for personalized investment and insurance portfolio generation. It is prepared by Serhiy Savchenko and Vitaly Kobets. So nowadays, various digital financial instruments find their application in many areas of the financial industry. The most popular use cases are credit scoring, insurance estimating, fraud detection, and risk management. And robo-advisors have become another popular type of financial instrument in the last decade. So robo-advisors are the part of asset management segment of the fintech industry. Robo-advisor is a type of financial advisor that gives investment advice and provides online access to the investment management dashboard. Most robo-advisors are designed for personal use, as they allow start making investments even for those who do not have a large startup capital, and provide an intuitive user interface to such features as choosing investment goals, risk preferences, budget, and desired investment assets. The output is an investment portfolio plan based on the input information provided by a user. The main advantages of robo-advisor systems compared to traditionally financial advising institutions, such as availability, low entry budget, and ability to fine-tune the parameters of the investment portfolio, and ability to plan funded pension system, they all stimulate the active interest of potential investors in such services. And as a result, this leads to the emergence of many fintech startups offering financial advisory services in the market of North America, Europe, and Asia. However, such systems are not widely available in Eastern Europe and in particular in Ukraine. So in this research, we have analyzed main features of typical robo-advising system, which include personalized investment and insurance portfolios generation. The purpose of this research is to develop high-level architecture of the robo-advisor as software for managing investment portfolios. Different legal restrictions hadn't allowed the traditional financial institutions to respond to new consumer needs, which led to the emergence of so-called fintech companies. Changes in the traditional concept of investing and insurance form a new sphere in the financial services market. Analysis of fintech services shows that potential benefits of fintech services include decentralization and diversification of financial services led by increased competition between traditional and robo-advisors. Another advantage is a high level of the efficiency due to modern technological approaches. For example, using machine learning and artificial intelligence techniques to improve decision-making process and to reduce costs. One more benefit is higher stability of fintech services due to reduction of information asymmetry between financial service providers and clients. However, the spread of use of fintech services also led to some risks, which include cyber risks as wider use of technology and digital solutions expand the range and number of entry points that could be attacked by hackers. And another type of potential risk is legal and regulatory risks, because there are different legal uncertainties and in some countries with, for example, smart contracts and robo-advisors and new financial instruments like cryptocurrency. In addition, one more type of risks is systemic risk, because complex algorithmic trading could cause new shocks in the financial markets. First, robo-advisors in their modern form of internet-based applications were created in the late 2000s during the financial crisis of 2007-2008. Nowadays, there are over 100 robo-advisory services which have a wide range of features. Some of them are focused on novice investors and have a small minimum account size, while others are focused on more experienced investors and have restrictions on the minimum size of the investment. The robo-advisors have next key features. Services operate only in the form of web application or software application for a smartphone or personal computers. All services are provided without the participation of traditional financial intermediaries. Services use an automated mechanism based on mathematical algorithm, and services provide high speed of operations. Based on studied works, we concluded that some of the most popular robo-advisors, including Betterment, Future Advisor, Motive Investing, Swap Intelligent, and Wealthfront, have almost the same key features. which include investment advice, automated investments, retirement planning, and customer service. However, there are some unique features which are present only in some of them. For example, mutual funds available only in Betterment, Future Advisor, and Wealthfront. Portfolio rebalancing isn't available in Motive Investing, and two-factor authentication is available only in Betterment. Currently, robo-advice platforms do not provide solutions for more complex financial needs, such as insurance or pensions, which constitute all other aspects of personal financial planning handled by financial human advisors. The insurance-specific module of robo-advisor, that is InsurTech, is still non-existent. We propose to add the insurance-specific module in robo-advisor architecture, which will be presented further. We have compared main characteristics of automated robo-advisors and traditional human financial advisors. The main differences are in customer service, advisor service, and methods of investment portfolio formation. While traditional finance advising companies use analytical methods based on the experience of financial advisors and statistical indicators of profitability and risk of financial instruments, robo-advisors use algorithmic methods based on modern portfolio theory, Markowitz-Tobin model, Black-Litterman model for optimization of profitability and risk. In addition, automated robo-advisors usually have lower fees. Robo-advisors author all finance instruments that human finance advisors do, but in addition, they currently start offering new instruments like cryptocurrencies, and other important differences include more flexible portfolio rebalancing options and better report settings in automated robo-advisors. Robo-advisors also offer 24/7 online access and the possibility to choose from different asset management strategies. This slide demonstrates investors' perceptions of human versus robo-advisors for the United States market. Human advisors lead on almost all points measured in the survey, no matter that investors choose robo over human advisors for charging lower fees. These results suppose that the hybrid model of cooperation between human and robo-advisors is currently the most realistic option. Human financial advisors may use different tools for analysis of finance and insurance products and recommend robo-advice platforms for investments to their clients. For example, Betterment robo-advising platform has introduced a call center with certified financial planners in order to monitor accounts and advices and providing advices. Modern robo-advising systems use the number of different machine learning techniques to build predictions about future financial instruments price and assets yield. The most used approaches are linear regression, random forest, k-nearest neighbors, support vector machines, and long short-term memory neural networks. Each of presented approaches has pros and cons. In our research, we focused on using multiple linear regression and long short-term memory neural networks. Multiple linear regression gives high interpretability but not very accurate results. At the same time, long short-term memory neural networks produce high-quality forecasts, but the results has low interpretability. On this slide, we present the robo-advisor system workflow, which consists of the following stages. The first step is user survey. It is used for determining the level of users' income rate, attitude to risk, investment goals, and time constraints. The second step is analysis of the information which is received on the previous stage. It is used for generating the personalized investment plan. The third step is presenting the generated investment portfolio in the user interface with the ability to change certain parameters. For example, the user can exclude a certain type of assets and update the investment plan. The last stage is providing access to the robo-advisor information dashboard for further work. We had analyzed each of the above steps and defined logical modules of the robo-advisor application. Summing up all the main features of robo-advisor, which are mentioned above, we propose the next high-level architecture for robo-advisor which presented on the slide. This architecture assumes that it is a web application that is accessed by the end user through a web browser or a mobile application. The module that provides an investment portfolio formation is the main part of the application. It uses data collected by the parser module and input information about the user's expected rate of return, desired maximum risk level, and other information. Insurance module is a part of the application that is responsible for providing the insurance plan that is also based on the information provided by the user. Profitability forecasting module uses different machine learning techniques to build models that could generate some predictions, for example, about shares profitability or average daily trading volume. And service logic is a module that runs scheduled tasks like periodic portfolios rebalancing, updating machine learning models, and detecting of abnormal behavior of shares price in order to notify users. Despite the fact that many papers state that fully automated processes of investment portfolio generation and the absence of any human interactions are one of the distinctive features of typical robo-advisor, a lot of customers note that they have a certain distrust of systems that are completely devoid of the ability to live connection with financial consultants. Thereby, the robo-advisor system also should have an additional module which will provide the functionality of some kind of human interactions between customers and financial experts. And such module isn't present in the proposed in the paper architecture, but it should be added in further development process. Most systems that could be considered as robo-advisors use Harry Markowitz's modern portfolio theory as a basic framework for building personalized investment portfolios. Markowitz model is a mathematical model for assembling a portfolio of assets such that the expected return is maximized and the level of risk is minimized. In the formal notation, where n is a number of assets, Rp is an expected return, sigma p is a level of risk, and Wi is a percentage of asset I in portfolio P. In general, such problem is hard to solve, and we should formulate the primal Markowitz problem for risk-seeking investor, or the inverse Markowitz problem for risk-averse investors type. Here, sigma g is a given level of risk, and Rg is a given expected return rate. The primary problem is used to assemble a portfolio such that the expected return is maximized for a given level of risk, while the inverse problem is used to assemble a portfolio such that the level of risk is minimized for a given level of expected return. Thus, in any of the above cases, the Markowitz problem is an example of an optimization problem which is solved by linear programming methods. We can form an investment portfolio using not only already known statistical data, but also use the predicted values for our assets, for example, the value or trading volume. Machine learning could also be used for choosing optimal assets distribution and clients classification. The profitability forecasting model, which is present in our robo-advisor architecture, could use various machine learning techniques. In our research, we focused on two of them. The first technique is linear regression. It is an approach to modeling the correspondence between some dependent variable and one or more independent variables. If there is more than one explanatory variable, then this process is called multiple linear regression. The formal notation for linear regression is presented on the slide, and here gamma is the dependent variable, beta 0 is a constant, beta I is the scope or marginal impact for the corresponding independent variable, and x is the independent variable. Using multiple regression could help in understanding which concrete factors have the biggest impact on the result values, even if the final result of the prediction isn't very accurate. So it could be used on the first stage of the analysis. Another machine learning technique that could be used for asset yield prediction is long short-term memory neural network. Long short-term memory neural networks are subspecies of recurrent networks, and their main difference from regular feed-forward networks is that neurons receive information not only from the previous layer, but also from their own previous path. Thus, the order in which we provide data and train the network is important. A big challenge in recurrent networks is the explosive gradient problem, which leads to the repeat loss of information, and long short-term memory neural networks try to solve this problem. On the picture, yellow cells are input cells, blue cells are recurrent memory cells, and orange ones are output cells. Each neuron from hidden layers has a special memory cell and filters that decide which and how much information would be stored and transferred to the next layer. Long short-term memory networks are well suited to time series predictions because they can determine and learn patterns in the behavior of the studied data that is repeated at certain time intervals. So, summing up, we have analyzed key features of robo-advisor systems and provided a high-level architecture for a typical robo-advisor, which includes modules for collecting input information from the client, profitability forecasting module, investment portfolio formation module, and insurance module. We have also covered the main mathematical models for investment portfolio formation and machine learning techniques which could be used for asset yield prediction. We also compared main characteristics of robo-advisor systems and traditional human financial advisors. Despite the advantages of robo-advisor systems, such as availability, low entry budget level, ability to fine-tune the parameters of the investment portfolio, and ability to plan fund and pension systems, they are still not well trusted by clients. Therefore, the hybrid model of cooperation between human and robo-advisors is the most realistic option for now. Robo-advisors are already actively developing in the markets of the United States, Asia, and Europe, and implementing such features as a personal funded pension, insurance model for investment protection, and collaboration with traditional human financial advising companies will boost their spreading on new markets and in particular in Ukraine and Eastern Europe. Topics which haven't been examined in this paper and which we're going to include in our further research include more complex mathematical models for investment portfolio generation, which include Markowitz-Tobin model and Black-Litterman model, human support model in robo-advisor architecture, and applying other machine learning techniques for analyzing and forecasting financial time series data. We are going to conduct an experimental effectiveness comparison of various methods of forming investment portfolios and predicting their return on assets. The next step is the choice of applied software technologies and the implementation of the main modules of the system according to the architecture proposed in our research. For now, that's all. Thank you for your attention. I'll be glad to answer your questions.
Thank you very much. Are there any... Marina, you're so quick.
Thank you. Thank you very much for the interesting presentation. I'd like to get some clarification. You mentioned in the abstract of the paper that your approach to design robo-advisor is different because it captures different attitudes towards risks. Could you please provide more details how it can be done?
Yeah. Thank you for your question. In this paper, we mostly focused on the software architecture of the robo-advisor application. And talking about risk preferences, it will be done in two steps. The first step is, and a second, I will show the architecture. So in this architecture, we have a questionnaire module, which this user will should to fill in, and then we will understand his risk preferences. And another option is insurance module, which will propose an insurance for your investments. This should be this will be researched in our further works, and for now, it is hard to answer how which techniques will be used in this module.
Okay, thank you.
Are there further questions? No further questions. Okay. Then thank you very much for your wonderful presentation. And I think this was the last presentation in this session. And we're going to continue at 1600 with Robert Rickert as the next session chair. Thank you very much for attending this session.
Thank you very much, Jan Hendrik, for your support.
Thank you, Tanya.
See you later.
See you later.